I'm Jamie O'Kane, CPA, Small Business Advanced Tax Planning and Compliance Extraordinaire, and this is the Abundant Beans Podcast, the podcast that takes my love for learning what makes people tick while digging into the good, bad, and ugly of small business ownership. We strive to give you the insight that only those in the trenches of being and working with entrepreneurs can provide.
5 ways that you can legally avoid taxes in the United States. Number 1, a held savings account. The money you put in is not taxed. The money you take out is not taxed as long as it's for medical expenses, and the money can be grown and invested within this account tax-free. Number 2, retirement accounts. This is your 401k, 403b, 457, Roth IRA. Max those out. This is money that the government is handing to you on a silver platter. Take advantage of it. Number 3, long-term capital gains. This is money within your taxable brokerage account, like your Robinhood account, TD Ameritrade, whatever you have. Anything held longer than a year within this account is taxed at a significantly lower rate than if you were to sell it within a year. For most people, long-term capital gains is 15%, but if you were to sell anything in under a year, it can be taxed as high as 37% depending on your income. Number 4, starting a business. If you run a business out of your home, things like internet, electricity, pretty much any utility can be at least partially written off your taxable income. Make sure if you're going to do this, talk to a tax professional to find out what qualifies and what doesn't. And finally, no, it's not life insurance, it's real estate. The amount of tax benefits that come along with real estate are too many to list here, but Google it. It's a lot. And follow basic financial literacy for more financial tips like this.
Pretty close. I would say on this one, he's correct on the health savings account. You want to make sure that you have qualified expenses. I know financial advisors and also tax people that will say, if you put that money in the health savings account and then cover it personally and hold on to all your receipts until later, then you can reimburse yourself eventually out of the account, but you cannot just take money later. You have to be reimbursing yourself for expenses. That was the second one.
Tax-free. Number 2, retirement accounts. This is your 401k, 403b, 457, Roth IRA. Max those out. This is money that the government is handing to you on a silver platter. Take advantage of it. Number 3.
Retirement accounts have 2 things. Either you're saving tax now or you're saving tax down the road. So either it's a tax savings today or a tax savings later. So yes, you can mitigate your current tax rate, but eventually you're going to take those dollars out and they might potentially be taxed. So this one's a little confusing. It's not really free money. That is also the case with Social Security. Depending on your income, when you take Social Security out, you might be taxed on none or up to 80% of your Social Security earnings.
Number 4, starting a business. If you run a business out of your home, things like internet, electricity, pretty much any utility can be at least partially written off.
It always makes me laugh when people say you're going to save taxes by starting a business. You can't write off anything that's not a business expense. He did say in proportion to its business use, which is what I always say, just because you have to make sure that whatever you're writing off has to actually have a business use. We don't get to just write off our entire car because we have a business. We don't get to deduct our mortgage. That's not how this works. You have to have a bona fide business use. And if you're saying, oh, well, my phone, okay, phones are kind of de minimis, but internet, things like that, it has to be in proportion to your business use. Home offices are nice though. And mileage is nice, but that requires you to start a business. Starting a business doesn't just inherently save you taxes or time. It doesn't do either of those things.
It can be at least partially written off your taxable income. Make sure if you're going to do this, talk to a tax professional to find out what qualifies and what doesn't. And finally, no, it's not life insurance, it's real estate. The amount of tax benefits that come along with real estate are too many to list here, but Google it. It's a lot. And follow basic financial.
Real estate's just like retirement. Very similarly, you get to take a lot. You can take depreciation deductions on real estate that may reduce your taxable income for the year, but you also have to have real estate. This is like the business part. You have to have the money to put into there to do it. But then we're also sometimes kicking the can down the road as the property appreciates. Then we're going to pay capital gain on the basis of the property, which is the price you bought it for, usually minus the depreciation you took. So you're going to usually get taxed on that depreciation amount.
Thank you so much for listening or watching. Be sure to subscribe on YouTube, iTunes, or wherever you prefer to listen. If you learned something and found some useful information to apply to your business today, please consider giving us a thumbs up and a review. Until next week, be abundant.